Good evening, class. How are you guys doing today?
Good evening, sir.
Good evening. Okay, is 8:30. So I want to do a 1.5 hours class with you guys from 8:30 to 10 p.m. Then we'll be done for tonight. You're welcome again to Equity Professionals. My name is Wasil. You already know that. And tonight we are moving to topic 2, which is IFRS 2 on share-based payment transactions. This topic will take us 3 weeks to cover, today inclusive, and is highly examinable. It was there last diet. 2 diets ago, it was there. So they ask it frequently in your exam. So you're likely going to see it in your exams again, this diet. Remember, on Saturday, we started with regulatory framework and, ethics in reporting. And for regulatory framework, remember I explained the regulations that governs reporting, as well as the regulatory bodies that enforce those regulations. And I told you that the regulation that governs reporting, we call it GAAP, generally accepted accounting principles. And there are 3 of them. There's the accounting standard, there's the company law, and there's the local stock exchange listing requirement. I told you the accounting standard we use in Nigeria is the IFRS. And the regulatory body in charge of that is the Financial Reporting Council of Nigeria, that has one important objective, which is to protect the interest of investors and other stakeholders. And it has other objectives, including to improve the credibility of the financial report. Then I made you know that the IFRS is not actually developed by the Financial Reporting Council of Nigeria. It's rather developed by an international body, which is mostly like a coalition of bodies, which we call IFRS Foundation Structure. I told you that this IFRS foundation structure consists of the monitoring board, who provides leadership and public accountability to the structure, and they contain majorly of capital market authorities. And this monitoring board appoints the trustees of IFRS Foundation, who is actually saddled with the responsibility to develop a single high-quality accounting standards in public interest, and also to promote the use and rigorous application of this standard. You see, these trustees of IFRS Foundation, they have 3 boards under them: the IASB, the ISSB, and the IFRS Advisory Council. The IASB develops IFRS. The ISSB is new, and they actually came in to provide a global baseline for reporting, or to guide us on how to disclose sustainability reports. Okay, so they are there for sustainability disclosures. And there's the advisory council that provide a link between the public and these boards, like that. And we also discussed further about the IFRS Interpretation Committee. We didn't stop there. I showed you the steps in developing an IFRS, and I ended up with some assignments. I gave you a total of 3 assignments last week. Can you please confirm that you have done my assignment? Is there anybody in this class that has done that assignment?
Yes, sir.
Good one, Hussein. Good one. So I would like you to forward it to me. I would like to see it after the class today. Let me just see what you have in your notes. Okay, any other person? Okay, I think I remembered Sarat. She was interacting in class the last class. Did you do your assignment? She ran away. Okay, guys. So the diet have started. I'm sure you are aware for most of you that are doing more than one course, and this is how it will continue for the next 17 weeks. We're going to be giving it to you back to back, like from all angles. Right now, if you want to pass, it starts now. If I'm giving you an assignment and you're not doing it, that means you're already putting your possibility of passing in doubt. And most likely, when it is August, you might give up and say, I don't think I can do this. This is the very moment you have to make out time and read. You might be very busy, but you just have to look for the time and ensure that you start doing those assignments. If you don't know about the assignments, that means it's either you have not watched the video or you just did not want to be aware about it. Okay, before I proceed to the topic of today, do we have any clarifications from the last topic? Anybody? Okay then. So that means we can proceed to our class for today. Okay, so now for today, we are going to be looking at IFRS 2 on share-based payments, share-based payments transactions. Now, the description of this standard is very subtle in the sense that it is just very clear exactly what the standard will be talking about, in the sense that the standard already the standard already make it very clear that all we want to talk about here is about using our shares, using the company's shares to make payments for transactions. From the name of that standard, share-based payments transactions. Now, you see, traditionally, or let me say conventionally, the way transactions are consummated, is, of course, there will be a buyer and there will also be a seller, right? So this buyer will usually request for goods from the seller. He will usually request for goods from the seller, and whenever he requests for goods from the seller, this buyer will then will pay in cash. He will pay in cash for those goods, or he might owe and say he wants to pay later. So you will have like a payables. Is either he pay in cash or he will, while the seller will transfer goods or services to that buyer, and he will make money. He will make like a revenue or an income. In accounting language, the buyer would simply receive goods, so he would debit inventory, or let me clearly call it purchases, which is the right debits, and money is going out from his hand, he will credit bank for the buyer. But you know that if the buyer buys that commodity or goods on credit, it means that instead of crediting bank, the buyer will have credited other payables. That's usually how we put it in our books in accounting. But for the seller, all he simply has made is that he's going to receive money or a promise to get money, which is receivables. And of course, he has made some income. You see, our business today is not around the seller. We are not concerned around the seller at all today, because I will teach you around the seller when I'm teaching you IFRS 15 on revenue. So the issue here is not the seller. The focus here is the person that is paying for goods or services, who is the buyer. That's our focus for today. So narrow your mind down that we are focused on the buyer, the person paying. And this buyer in question, we are saying that, yes, he has received goods or services. So we say that you debit your inventory or your purchases, and we're going to credit, in this case of share-based payment, we're going to credit his share capital, because here he's paying with his share capital. And that is why this topic is called share-based payment transactions. We are saying that the person that is buying, instead of him to pay with money, to pay with cash, is paying with his shares. And that's everything I want to teach you tonight. Ordinarily, with what I've explained so far, I've told you a story. I've actually took you through like a line of thought, saying that conventionally, the way buyers consummate transaction is that they would buy goods or services and they will pay in money, or they will say, I will pay later. That's how transactions are done. But we are saying that there is a way, there is an opportunity for the buyer not to pay with his money right now. That instead of paying with money, he would pay with his shares. That he will give that company his shares. Imagine a company like in Nigeria now, a company say GT Bank. You offer them a service. They now say that, okay, we're going to give you some of our shares. Won't you take it? Of course you will take it. I mean, there's this story we had about when Facebook started. The guy that painted their office, as at then, I think the guy charged them, I think, $10,000 or thereabout. Facebook being a startup, they offered the guy shares that, okay, we are managing to give you part of our shares. I mean, the guy just said, okay, because then he knew that if he had collected the money, he would have spent it. That, okay, no problem. Now, this story I'm telling you, it was the guy that was saying it, that he is now a millionaire in dollars as a result of that transaction he entered into. And that is what we want to talk about today. However, I'm going to narrow it down later, that The buyer here, the buyer in this case here, I'm going to very soon narrow it down to employers. Employers that buy services from employees, because that is where it is popular, where especially these startups, where they see talents or people that have skills, in addition to the monthly emolument or salary they give to those staffs, they would also promise them shares in the company. Or when an individual becomes a director in a company, they would usually want to give that director some share compensation just to enable him to put all his efforts in the company. And you will see later that that's the focus of IFRS 2, where the employer is the buyer and the seller in this case is the employee. So we are going to focus more on that. I mean, you should be thinking in your mind right now that, okay, if that is all IFRS 2 is all about, why is there a separate standard for it? Why are we all seated here today wanting to learn this for almost 1.5 hours? What's the big deal there? Because, I mean, I'm putting this double entry in front of you and I'm taking my time to let you see so that you can think that this is all I want to teach you today, where either the buyer or the employer he gets service from a counterparty, and instead of paying money or saying, okay, I'll pay you money later, he's saying, okay, I want to give you my shares. And this is the double entry, inventory and share capital. That is it. Now, why can't I stop here? You will see it very soon. You will see it very soon. So now, these transactions, which you call share-based payment transactions, it can be done in three ways. It can be done in three ways. Number one, where the buyer, which I said that it might also be an employer,
I'm so
where
sorry, I just joined. Please, I want to know the topic for today.
share-based payments, IFRS 2. I asked you to join early enough.
I'm so sorry about that. Thanks.
Okay, there are these transactions, share-based payment transactions, can be done in different ways. The very first one is the one I've explained heavily already. Where the buyer, okay, somebody raised up a hand. Oh, yeah, please go ahead.
Good evening, sir. Could you please share the lecture material with us? I'm just joining for the first time, so maybe I can
Just
catch up with
put
the
it,
previous lecture.
just put it on the go. There's no way I can share while I'm teaching. Just put it on the
Okay,
go that, and your fellow students will have shared it to you since.
all right, thank you.
Yes, please, any of you can just re-forward the material. And I don't think you need the material right now. What you need is this board and your notes, your writing pad, not the material. Please focus on this board right now. Okay, please, let's pay maximum attention, at least for the next 15 minutes, where I want to explain the core principles. Pay maximum attention and get it once and for all, please. Again, these share-based payment transactions, it can be done in three different ways. The first one is the one I've explained heavily before, where the buyer or the employer receives goods or services, where the buyer, okay, sorry, as I was saying, so where where the buyer or the employer receives goods or services, and in exchange for that, he gives his shares or share capital to that counterparty. That we call equity settled share-based payments transactions, where the buyer receives goods or services, but instead of paying with cash, he pays with the entity's equity instrument. Okay, so the entity pays for goods or services with its equity instrument. The second one, of course, where is still the buyer or the employer that receives goods or services, but the way he's going to pay now is that he's going to pay cash, whose value is dependent on the share price of that company. Again, for this one, the entity receives goods or services. Okay, either the buyer or the employer, they are the same people. But now he's saying, okay, I'm going to give you cash. But the value of that cash I'm giving you will be determined by my share price. So there's a way they will have agreed it. Okay, later I will teach you that. So we usually call that cash settled share-based payments transactions. So the entity pays for goods or services with cash, whose value is tied to, or whose value is based on the share price of the entity. In fact, the way this is done, they call it share appreciation rights. Share appreciation rights. So there's a way they will have given that counterparty or the person that is offering service, they will have given him something they call share appreciation rights. That this, as soon as our share price increases by, let's say, 10%, okay, you will get paid cash. So there's nobody that will not want to key into that. It's just like you offered me, you went to GT Bank, you offered them a legal service, and they said, okay, do you want cash now? Or we're going to give you cash later, but we're going to give you the cash based on our share price. They will say that if our share price increased by 20%, okay, you are going to get paid based on that price. So they call that share appreciation right. Or they can give the counterparty redeemable shares. Redeemable shares. So they will give him shares that take our shares for certain number of days or certain number of months. Then we're going to buy it back from you. We're going to buy it back from you. So they give him redeemable shares. These are the ways in which this cash settled share-based payment operates. The entity receives goods and they say, okay, I will give you cash. And this cash, the amount, the value will be based on the share price of the entity. The third one, we call that equity or cash settled. That one is in the middle. Equity or cash settled share-based payment transactions. You see, for this, either the buyer, you see, either the buyer or the counterparty, who is either an employee or a supplier, I mean, the person providing the service, or the counterparty has a choice or can decide whether the entity will settle with the entity's shares or equity instruments or with cash. Of course, this cash, whose value is based on the entity's share price. So now this equity or cash settled, that one is in the middle. Unlike equity settled, that one is affirmative, that okay, I'm receiving good and I'm going to pay you with my shares. Cash settled, that one is affirmative, that okay, I'm receiving good and I'm going to pay you cash. But the amount of cash I will give you is based on my share price. But the third one, they are not sure. It's not specific. So the determination of whether cash or shares will be determined either by the buyer or the counterparty. Either of them can decide. Unlike the other two, equity settled and cash settled, where it was the buyer that is saying, okay, I'll pay you in shares, okay, I'll give you cash based on the value of my share price. Of course, the two of them will have agreed. But this one, they made it open. They made it open that, okay, I'm giving you opportunity, take your time, decide whether you want me to give you shares or you want me to give you cash that will be tied to my share price. So these are the three ways in which these transactions, these share-based payment transactions can be consummated. These are the three ways it can be consummated. Now, see, all I want to teach you today is just simply how to account for these three transactions. And like I assure you, it's not more than what I've shown you here before. Just with some little adjustments, which I really need you to know today, every one of you. So now, before I pick each of them, because I'll pick this one, I'll dissect it, pick the second one, do the same thing, pick the third one, do the same thing. Before I do that, there are some terminologies I really need you to be familiar with. And the first one is share-based payments transactions. Okay, even without me telling you this, you should know that share-based payment transactions are transactions in which an entity receives goods or services in exchange or as consideration for its equity instruments. Okay, an entity receives goods or services as consideration for its equity instruments or is going to settle with cash based on the value or based on its share price. That's share-based payment transaction. An entity receives goods or services, and in consideration for that, he either gives the counterparty his shares or equity instruments, or he gives the counterparty cash whose value is based on the share price of the company. That's a share-based payment transaction. This is like everything, both equity settled and cash settled. That's all I've said. Now, the second one is equity instruments. Remember, for equity settled, the buyer is going to be settling with his equity instrument. And this equity instrument can either be shares or share options. This equity instrument can either be shares or share options. Shares is where the buyer issues shares to the counterparty outrightly. He issues shares to the buyer. That's shares. When I give you my company's shares is shares. I mean, automatically that counterparty becomes a part owner in that company. That's I'm giving you my shares. You automatically becomes a part owner in my company, a shareholder in my company. But if the equity instrument in question is a share option, this one usually comes with a condition before it can become shares. So share option is like a right given to a counterparty, to buy the company's or the entity's shares, at a specified date, at a specified price. So share options is usually the one you find entities giving to their employees. They will give it to their employees because they know that this one does not become shares immediately. It takes time. So all you have here is a right, okay, to buy the entity's shares at a specified date, at a specified price. It's just like you become a director in a company. They now say, okay, we are giving you 10,000 options and you can exercise it in 5 years. All they are telling you is that you cannot, we are just giving you a right to buy our shares in 5 years. We are just giving you a right to buy our shares in 5 years. So that's share options. So, and you see, these share options, the dates, there's usually, and in fact, there's usually like a grant date. Let me call it a grant date. It's like the date where they get when they agreed. The date, in fact, the date the share-based payment transaction was agreed. Share-based payment transactions. Share-based payment transaction was agreed. That's the grant date. And there's another one we call exercise dates. It's like the dates the counterparty now can receive the shares. So when they give a share option, I've told you that it's not shares immediately. It's only a right to buy shares. So the day they give you that option, or the day that share-based payment transaction was agreed, is we call it grant date. The date where you can receive those shares is called exercise dates. That's when you can then receive, that's when you can then buy those shares from the organization. Now, before you can buy those shares, they would usually attach it to some conditions. They call that vesting conditions. This vesting condition can either be service conditions, where the counterparty, usually an employee, would be required to work for 5 years, for 3 years, for 2 years before he can become entitled to those shares, before he can buy those shares. They will ask him to work for some years. That's vesting conditions. Or it could be performance conditions, where either the director was told that before you can receive these shares, before you can buy these shares, you must make sure they can say you should improve their profits from one level to another, or to take their share price from one level to another. Eventually, when it meets this condition, then it will then vest. The share-based payment arrangement will vest. And what I mean by vest is when the counterparty becomes entitled to the shares. That's what I mean by vest. Okay, I've met all the conditions, so this whole arrangement can then vest. Of course, all of these things are usually backed up by an agreement, which you can call a share-based payment arrangement. There has to be an agreement between the buyer and the counterparty that, let's make it clear, we are going to be paying for these goods or services with our shares. They will make it very clear. Or with our share options, they will make it very clear. So it will be in the agreement. And finally, there's something we call intrinsic value. I mean, if the arrangement does not have an intrinsic value, nobody will agree to it. Nobody will agree to it. Is this intrinsic value? That's the attractiveness of the arrangement itself. If it does not have intrinsic value, no employee, no supplier, nobody would want to enter into such transaction. They would rather want to just collect their money and walk away. They would rather just want to collect their money and walk away. But what do we then mean by intrinsic value? Intrinsic value is saying that okay, we are saying we are giving you a right to buy our shares. And we are saying these are our shares, buy it for, let's say, 5 naira, which is the exercise price. Let's say this is the exercise price. And the market price of our shares, if we're going to buy it in the market today, is 12 naira. But we are saying that, guy, we are giving you a right to buy it for 5 naira. Instead of you to go to the marketplace and buy it for 12 naira, we are saying buy it for 5 naira. Of course, that's attractive now, isn't it? Yes, it is. So there's an intrinsic value of 12 naira minus 7 naira of 7 naira here. This is the attractiveness of this whole arrangement. Without this, nobody will agree to it. And that's intrinsic value. Okay, so I need you to look at all of this. The way I've explained it to you sequentially very well. Everything you need to understand
Sorry,
most
sir.
of the things I'll be
Hello.
saying very.
Good
Yes,
evening, sir.
good
Sorry,
evening.
go over this intrinsic value again. The line was, my network was going on and off when we were explaining the excise and market price.
Okay. So intrinsic value is the reason why any counterparty, either an employee or a supplier, would enter into this transaction. Intrinsic value is the reason why they will not say, please give me my money, let me walk away. I don't need your shares. Is intrinsic value that makes them want to stick to this kind of arrangement. And intrinsic value is saying that, okay, we are giving you a right to buy our shares for 5 naira, which is exercise price, 5 naira. Instead of going to the market to buy it for 12 naira, because that's the market price of our shares. If you have gone to the market, you buy it for 12 naira. But we are saying, guy, you can buy it for 5 naira. So that goes to show that there's an intrinsic value of 7 naira. Intrinsic value in terms of, you can see it as a profit that counterparty can make. Because if you ultimately buy it for 5 naira, then he can just go to the market and sell it for 12 naira. He's going to make clean 7 naira. Clean. And this 7 naira is the intrinsic value. Is the difference between the market price and the exercise price. Is the reason why any rational counterparty would want to enter into a share-based payment transaction with an entity. Intrinsic value. If there is no intrinsic value, no one will enter into this type of transaction. No one. Now, I've explained share-based payment transactions where the buyer receives goods or services and he either pays with his equity instruments or with cash whose value is based on its share price. And I said equity instrument can either be shares or share option. Shares, if they pay with shares, that counterparty or that supplier automatically becomes a shareholder. That means they are issuing shares to you outrightly. But if it is with share options, that only gives that counterparty a right to buy those shares at a specified date in the future at a specified price. And the date where this share option is given is the grant date, or the date where the agreement was made. That's the grant date. And the date where the counterparty can receive those shares is the exercise date. And usually share options would come with vesting conditions. To come with vesting conditions, which could either be service condition that you have to work with us for 4 or 5 years, and that means that if the counterparty leaves before then, he's not going to get anything because it will not vest. And there could be performance conditions as well. If the counterparty is patient enough and is able to meet the vesting conditions, of course, it will automatically vest. When it vests, it means it becomes entitled to the shares. And the backbone of this entire arrangement is the intrinsic value. It's because the counterparty knows it's going to make some clean profit. Without this intrinsic value, this agreement cannot happen. And this intrinsic value is the difference between the market price and the exercise price. It's like saying that buy our shares for 5 naira. Our shares that is worth 12 naira in the market. We're saying buy it for 5 naira. Buy it for 5 naira. So you're making 7 naira profit. Or you will make 7 naira profit, as it were. Okay. I want to believe that is very clear. Now, moving on. Recognition of share-based payment transaction. You see, generally, when we say recognition, every one of you here should know that it means recording in our books. That is recognition. So how do you record this share-based payment transaction in the books? In fact, before you can even go ahead and record it, when can you record it? In fact, before it can be recorded, the goods or services must be received by the employer or the buyer. And don't forget, please, that was how I started though. I told you that the focus is on the buyer for this standard. The person that is paying, not the seller at all. And I also went ahead and told you that this buyer, I'm still going to narrow it down to employers. I will narrow it down because is for for other ones that are not employer, it's really very easy to account for it because it doesn't go beyond this. But for employers, that's what the examiner will test you on in the exam usually, but we'll get there. So firstly, knowing that we are focusing on the buyer, so when I say recognition, I'm talking about by the buyer. So the buyer recognizes this transaction when he receives the goods. Okay, So if the agreement is that of equity settled, where they have agreed that I'm going to settle with my equity instruments, right? So all the buyer does is the good he has received, he will debit inventory, and he will simply credit shares or share capital. Okay, that's if he's issuing shares. But if he's issuing share options, that means he's not going to issue shares immediately. Can I please ask you this? If he's issuing share options, what do you think he will credit? Instead of, he can't credit share capital if he's issuing share option, because that one is not issuing shares like immediately. It's much later into the future. But he needs to credit something now. What do you think he will credit?
Liability.
Nope. You tried, but it's not liability. In fact, you can only credit liability when you have an obligation to deliver cash. Okay, that's when you have a liability. Here now, he doesn't have obligation to deliver cash, but share. So it's still equity instrument, but we call it equity, is a reserve. You will put it under equity, but as equity reserve. Okay, so if he's issuing shares, it's share capital. If he's issuing share options, equity reserve. And this is why the examiner will never give you this type of transaction when it is with like a supplier, because it's very straightforward. But because for supplier, you cannot give a supplier share options. No, you would rather give him shares immediately, because the supplier would have offered the service immediately. So, but if it is with an employee, he's an employee, you can be giving share options too. Because I told you that share options will result in vesting conditions, because you need to meet some options. You will need to meet some conditions like service conditions, performances. Employee you can be doing all that with. And that's where this equity reserve comes in. And we're going to take some time to explain this very soon. Second one, if it is cash settled, yes, the buyer will record it by debiting inventory. And don't forget, cash settled means I will give you cash, but this cash will be based on my share price. What do you think you can credit? What did I write on the board?
Share capital, sir. Okay, liability.
Liability. I just mentioned when someone mentioned liability for me for this one, I said no. The liability can only arise when you have an obligation to deliver cash, which is exactly the situation here. For cash settled, you are promising to give cash based on your share price, but ultimately you give cash, so you credit liability. That's for this. But the one that is equity or cash settled, so that one, yes, you are still receiving goods, so inventory. So that one, you can either credit your equity reserve or liability, depending on what they decide eventually. But I'm going to teach you this probably in the next class, not today. That's when you're going to address it. So this is how you recognize share-based payment transactions. This is how you recognize it. So as soon as you receive goods, as soon as the buyer, you receive good, then you can then go ahead and record it in your books. Very straightforward, isn't it? Emmanuel, can you please stop writing on my board? Thank you. Let me stop sharing and reshare so I can reclaim my board. Okay. Any questions to this point?
I have a question, sir.
Emmanuel, go ahead, please.
The cash settled payment transaction type. I understand the inventory part, but It is the crediting of the liability part I'm still trying to get clarity on.
That one is straightforward. You will learn like over and over again. I will teach you over and over again that whenever you have an obligation to deliver cash, that means you owe money. That's a
Mm.
liability. That's a liability. When you have an obligation to deliver cash, that's a liability. Straight on.
Which depends on
That's
the value of the stock in the future.
exactly,
But
exactly.
then how? Because if, for instance, now maybe if because now that means we cannot be able to tell the real value of that liability today.
Exactly now, which is why in accounting we make estimates. So we'll have made some estimates. I'm not will have
Based
given
on
us
estimate.
exactly.
So meaning that if I'm preparing financial reports, let's say for the month of July 2025, and then
Yes.
we are supposed to redeem this we're supposed to be sure of that liability in August 2025. So whatever management
Mhm.
reports or financial reports I present in July 2025 is still amendable.
I'm
We
not
still have
going
to
to
go back and
no, you amend it. That's not how it will work. That's not it. In fact,
oh,
practically, the way it will have worked is this. When you enter into this type of transaction with somebody, so you would have seriously agreed like a price. You will have maybe the share price of the company is 10 naira. They will say, okay, we'll give you money when our share price is let's say 15 naira. So they will have calculated this liability based on 15 naira.
okay.
Yes. So
But is there a
eh,
time frame for it?
yes, there will be time frame for it. There's always going to be time frame for it. It cannot be forever
Okay, what
because
if during the time frame set and then the share price of the company falls below?
I mean, unfortunately, they will have
I
to.
thought about it before asking these questions. That is why
Yeah,
I'm
yes. It makes a lot of sense. So, which is why, I mean, why any entity will go into this type of transaction is they see that this is a company that has potential to grow, whose share price will not just fall unexpectedly. So it's companies that you can know that, okay, based on our trajectory, based on our fundamentals, our
mm,
prices will go up. Otherwise, that's a loss. So it's a loss. If the prices should fall, it's a loss to that counterparty. Unfortunately, to be a loss because it might not want to wait forever. It will just have to exit, or they will find a way to exit out eventually. Yes.
okay.
Yes, they'll find a way to just exit it because if it doesn't get to that price within a relevant time frame, it becomes a challenge. So, which is why you only find um, good companies like that has whose currency is valuable, whose shares are valuable. Those are the those are the kind of entities you will find going into, especially cash settled. Equity settled is still a little straightforward, but cash settled, that one you are promising that our share price will go up. So it's a little, I mean, it has some element of risk, which is why it's a liability anyway. So one way or the other, the company has to pay.
Okay. So for instance, if the share price falls now,
Mhm.
and they have to pay, mean that they will have to expense the loss on top of it at the end of the day.
Exactly. Something like that.
Ah, Jesus Christ. No, this shouldn't be an option.
Yeah. Depends. Depends. Eh, but you're asking a very rational question. It makes sense. Okay. Nice one, Emmanuel.
Thank you, sir.
Now, yeah. So let's move on to measurements. Measurement. Let's start with equity settled. So when I say measurements, what I mean is this debit to inventory and credit to share capital or equity reserve. I mean, how much at how much are we going to put it in our books? This should be straightforward, right? The only thing is just that, you see, inventory or purchases, there is always an invoice. When you buy goods, you always know the value of the goods or services. It's always very clear. The value of the goods or services when you buy goods or service. So you can easily record that. However, share capital or equity reserve, I don't want to focus more on share capital because you won't find that majorly in the exam. So for the equity reserve parts, you see, this one will be based on the value of that share options. Let me see the fair value. That's how we call it in reporting. To be based on the fair value of that share options. So that means that this inventory, we have its own value. This equity reserve has its own distinct value. And they will not be the same because you bought goods, you bought service from somebody. The person will have told you, this is the worth of my goods. But you said, okay, I want to give you my shares. Your shares too will have value. It will have value. So that's the challenge here. And in accounting, what you debit and what you credit, you have to enter them with the same value, not different values. So in this case now, which value should we use? Which value should you use? So IFRS 2 says that equity settled share-based payment transactions, share-based payment transactions should be measured at the value of the goods or services. So that means is the value of the invoice that supplier has given you. That's the one you rely on. That's how you're going to measure both the inventory and the equity reserve. That's how you're going to put it in your books. However, if the counterparty or the supplier happens to be an employee, if the counterparty is an employee, you cannot use the fair value of the goods or services. Why? Because we cannot reliably measure the value of that goods or services. It's just like a director. You told the director that, okay, I will give you my shares in the future if you work with me for 5 years. Ordinarily, the director will be collecting salary every month, or the employees will be collecting salary every month. And so how do you want to measure that portion of service that you are giving us shares for? Okay, so to avoid complexity, so if the counterparty is an employee, which is what you find in the exam, you will not find this one in the exam because this one is quite straightforward. It's very, very too straightforward. So don't expect the examiner to give you this one, except probably maybe in question 1 as part of additional information, maybe, because it's straightforward. But they will give you when the counterparty is an employee. In this case, if the counterparty is an employee, the equity settled share-based payments will be measured at the fair value of the share options and the grant dates. Note this, it will be measured at the fair value of the share options at the grant date. Note this at the grant date, meaning the date at which the share option arrangement was agreed. The day they gave that, okay, we will give you shares, the day they agreed, the fair value of the option at that date is what you are going to use to measure the value of the transaction. If you understand this, you're doing well, very well. So for equity settled, is either you measure it using inventory, which is the value of goods or services, or the value of the share options. IFRS 2 states that equity settled share-based payment should be measured at the value of the goods or services. However, if the counterparty is an employee, it's not possible, it's not practicable to measure the value of the goods or services. For that reason, the equity settled share-based payment will be measured at the fair value of the share options at the grant date. So we are using the fair value of the shares instead of using the fair value of the goods that we received. We are using the fair value of the option. Now, for transactions with suppliers, where a supplier provides goods of 20 million and the entity exchange its shares worth 25 million for these goods. How will this transaction be measured? Who can tell me the answer? How will this transaction be measured?
It will be measured at the value of the goods.
Thank you very much, Emmanuel. Which is how much?
20 million.
Thank you very much. Thank you very much. So good. Now you understand the whole story. What if, instead of a supplier, what if this was an employee?
It will be measured at 25 million.
Thank you very much. Which is the value of the shares. Okay, good. Okay, good. Okay, good. Now, I'm going to focus on employer-employee relationship because the buyer and supplier relationship is always straightforward. Is always in this manner. All you just need to know is that the entity is going to measure the goods at the value of the goods. That's all you need to know. But where the transaction is with an employee, here's the challenge that we have. Let me show you now. You see, let me focus on provision of services because employee will not provide goods. An employee will provide service. So services can either be provided either at a point in time or it can be provided over time. If services are provided at a point in time, it means that the counterparty provides the service one-off. Like there's an immediate delivery of service. And as soon as there is an immediate delivery of service, that means the entity can go ahead and recognize the entire value in its books because the recognition criteria for share-based payment transaction is where the goods has been received by the employer or the buyer. So if the service is provided at a point in time, like there's an immediate delivery of service, the entire transaction will be recognized immediately in the books by the buyer because he has enjoyed the service immediately. But where services are provided over time, where it takes like 3, 4, 5, 6 years for the provision of service to be completed, it means that if the compensation we are giving for that service is 20 million, and it will take 6 years to provide that service, my dear students, this 20 million is going to be recognized over 6 years, meaning in year 1 to year 6, you just need to be doing 20 over 6. If you punch your calculator with 20 over 6, it should give you around 3 point something. That means you are going to be recognizing 3 point something million in year 1, in year 2, in year 3. That is how we do it in accounting. Who can tell me the concept in accounting that support what I've just said now?
Depreciation.
Periodicity concept, sir. Periodicity concept.
Matching
Periodicity,
concept.
matching concepts. You're getting there. You're very close.
And it's also under IFRS 15 too recognizes this for contracts
Yes,
transaction.
yes, of course it does. But there is a concept, you have not mentioned it. Yes, there's periodicity, there is matching, but that does not address this. What's that concept was called?
So I was saying
Accrual.
accrual concept.
Sorry, I didn't hear you. That concept is called accrual. Accrual concept in accounting.
Mm.
You see, that's the opposite of cash. Is accrual. So the person that said matching, yeah, I won't say you're wrong because you're actually right as well. Just that matching focuses on matching expense with income. Okay. Okay. In accounting, we match expense and income. But accrual is saying that every year we recognize economic activity. We recognize the value of what we have received. It's just like you paid rent for 2 years. You know that you will not go and recognize the entire rent in your as expense your P&L for that year. You only recognize 1 year as rent. The
True.
remaining we are going to prepare it. So the same thing for year 2. So if the service is over time, we are not going to recognize the entire 20 million. We are going to recognize it piecemeal, small, small, because of accrual concept. Now it is that straightforward. Now, so let's say if an entity gives 500 options to 20 employees, on the condition that they work with the entity for 5 years, and the fair value of the option at the grant date. In the exam, they won't call it grant date. They will just tell you the date when they made the agreement. They will say, in fact, they will tell you that the entity gives 500 options to employee on 1st January 2022. You need to know that 1st January 2022 is the grant date because they will have given you the fair value of the options at that grant date. They will now give you some other fair value at different dates just to test you. And don't forget, that's why I painted this one red. For transaction with employees, it's measured at fair value of the options at the grant date. As I was saying, So the fair value of the option at the grant date is, let's do funeral. It's funeral. So how will the buyer or the employer, the entity, measures this transaction from year 1 to year 5? I'm sure with the explanation I've given you, every one of you can do this. So the first thing you need to do is that, what's the value of this entire option itself? What's the value of the option that I'm giving to my employees? Is
Funeral.
no, yes, it's 4 naira. So, but I'm giving 500 options to 20 employees, right?
2,000.
Okay. Can you
Sorry,
recall? It will be 500 times
Okay,
20.
the total monetary value.
Yes.
okay. But
So how much is that?
40,000.
40,000. Thank you. 40,000. So this is the value of the entire options as it is, the date at the date we agreed. Abi? So year 1, who can tell me how much are we going to recognize in year 1?
8,000.
8,000.
It is 8,000 naira, sir. 8,000.
How did you
8,000.
get
8,000 naira
that?
divided by 5.
Thank you very much.
40,000 naira divided by 5.
That's correct. That's correct. 8,000. So how much do you recognize in year 2?
8,000
8,000.
naira
Same
also, sir.
8,000.
Thank you very much. You get the idea. You guys are fantastic. So year 1, 8,000, year 2, 8,000, year 3, 8,000, year 4, 8,000, year 5, 8,000. And that's how it's going to happen. Who can tell me the double entry for this 8,000 in each year? You have forgotten? We debit staff cost.
Salaries.
Yes, or debit
And
salaries.
you credit reserve equity. Equity
Thank you.
reserve.
That's correct. Absolutely correct. You debit staff costs and you credit equity reserve. Absolutely correct. The good news is that it's not going to be this simple in the exam. Do you know why? The reason is that in reality, these 20 employees, is not all of them that will stay for 5 years.
True.
Some of them will leave. Is either somebody die or somebody changes job. Not all of them will stay. Not all of them will stay. So let's now say that in year 1, let's say in year one, let's say 5 employees leave. Let's say 5 employees leave in year 1. We need to move this thing down. So let's say 5 employees leave in year 1, at the end of year 1. This is going to show it will change the entire dynamics of this now. It means that the value of the option will now be 500 options multiplied by how many employees now?
15.
Thank you very much.
495, sir. Okay. Oh,
15
sorry.
employees. Yes, 15 employees. multiply by what?
4.
By naira. So,
Oh
which is
no.
going to be how much?
30,000 naira,
30,000.
sir.
Sorry, again?
30,000 naira.
30,000 naira.
30,000
So,
naira.
how much do you recognize in year one? Is it this
40.
30,000?
8,000
How much?
was recognized. Okay, okay, no,
Yes,
we can't recognize 30,000.
How much do you recognize in
No,
year one?
6,000.
that is
Thank you
30,000
very
divided by
much.
5.
Thank you. Thank you
6,000
very much.
naira, sir.
Thank you very much. 6,000. 30,000 divided by 5. This 30,000 is the entire value. What we are going to give them if they stay with us for 5 years. Okay. Now we are saying that Akura concept says you recognize it year by year. So in year one, you just say 30,000 divided by 5. Okay. Let's say in year one, okay? Let's say in year one, let's say three employees leave, and the entity estimates that 12, no, it's too much. 9 employees will leave over the 5 years. And the entity estimates that 9 employees will leave over the 5 years. So in this instance now, what is the value of this option? The total value of the option? Yes, I know that I'm giving 500 options now. To how many employees now?
17
Sir, can I?
employees, sir.
Okay, 17 employees. Okay. Any other opinion?
8
I wanted
employees.
to
Yes, I think it's 17.
Okay,
I think
17.
it's
Obed.
12. 12.
Wait. How did you get 12, Christopher?
It was fifth, initially the 20 employees, 5 left. So
No,
I
no,
have a
no, no, no,
balance
no.
of 15.
Okay, let me delete this one then. This is another assumption. I'm just giving
Okay.
you some
Okay.
example.
Okay.
Yeah, this
Okay. This is a
example.
fresh one.
Yes, this is a fresh one.
Okay.
So
Okay.
yes, so this is
But we are
another
still
year.
working with the 20 employees.
I think
Oh,
it's
yeah, I'm here.
11,
Yes.
guys. 11. 11. Yeah, 11.
Okay.
11,
Yeah.
yes, 11.
Because that's an estimate. So it's a provision just in case.
Okay.
20
So
3 left. You
nine
minus that 3 from the
of the
one
5.
given.
okay, so we have two options now, either 17 or 11. So which one is the correct answer? Some people say 17, which obviously are saying, okay, we have 20, then 3 left.
Mm. Mm.
Why
It
some people are
means
saying
11.
the entity estimates that 9 will live over the 5 years, so it should be 11.
Yes, 11.
11 is the correct answer.
Yes. Yes.
11 is the correct answer.
Yeah, that's an
Because,
estimate.
exactly, I mean,
They are yet to leave now.
yes, they are yet to leave, I know. They are yet to leave, but since the examiner has given you the estimate, in fact, that's the standard IFRS 2 allows this estimate. Because I cannot work with people that live in year one alone. I cannot work with people that live in year one alone, except if the examiner didn't give me any further estimates. I cannot work with just people that live in year one. What about people that will live in year two, year three, year four, year five? What I want to work with from year on year is the monetary value of what I know I will give the people that will remain. the people that will not go. So it pays me that that my value should be close to that, not overvaluing my valuation. If I should use 17 employees now, I'm overvaluing this option because the I want to know the monetary value of what I will give the people that will remain in year 5. That's my focus. That's what I want to share over the 5 years. Not people that will live in year 1 alone. I do that one. No, no, no. That would be very rough. So I will work with 11. Since the examiner already made my life easy, he told me that yes, 3 people live in year 1. Fine. They now said they estimate that 9 employees will leave over the 5 years. Fantastic. So that means the examiner has made my life easy. And they are telling me indirectly that the only people I will give this 500 option to is just 11 employees. Yes, they have not left, but we are okay with estimates in accounting. We make estimates. We love it. In fact, that's what the standard said. The standard said at the end of each year, we have to estimate the number of employees that will depart over the period. So you just simply multiply by 4 naira. Can you give me the figure?
22,000.
22,000. So if this is 22,000, how much do you recognize in year 1?
4,400.
Which is 22,000 divided by
4,400.
what?
5.
22,000 divided by 5. 4,000.
4,400, sir. 400.
This is the end of equity settled share-based payments. So let's solve some questions.
Sorry, sir.
Yes, I'm with you. Go ahead. Go ahead. Oh, are you having network issue? We can't hear you again. Oh,
I have a question, sir.
go ahead, Emmanuel, please.
When we were talking about stock options, I
Okay.
was listening at it literally, like you being given being given a choice of enjoying a stock at an agreed date. So, but when I began to see 500 options, I began to, is it that there's a number of options that one can get? I'm just not, I felt maybe the stock option is more or less like a compound sentence. When I begin to see something that is more than one, to point to having 500 options,
This is similar to
I don't
500 shares.
think, sir?
This is similar to 500 shares. But just that we
Oh,
cannot call it shares now because the guy needs to work for 5 years. So that's why we still calling it stock options or share options. Or
oh,
we just simply call it options if you wish. Well, so it means that if the few of them that remains, each of them would have 500 shares.
oh, okay,
Yes.
okay, no problem.
Oh,
This is clearer now.
good.
Hello?
Yes,
Yes,
go
sir.
ahead.
I have a thought concerning this. So for the employees leaving, I think the time that they left will have a role to play in our calculation also. Because if they left at the end of the first year, I think they will be due to collect the option for that year.
They are
I
not
don't,
collect
sir?
the
No,
condition. They won't collect it. The condition is that they have to work for 5 years. Anybody that does not work for 5 years will collect nothing.
Okay.
Even
Okay.
if you live in the 4th year, you will get nothing.
Okay.
You need to
Thank
work
you.
for. You're welcome. So I want to believe everybody understands this. The people that are exiting this class, I don't know. We need to do orientation very fast. How do they want to cope? Okay, let me switch to some questions for us to play around with. Okay, can you see this new screen?
Yes.
Okay. Okay, so I'll just be able to solve one question with you because I have one meeting by 10 o'clock. So let's see if we can solve this question.
2 minutes to 10 already.
Okay, maybe we should just continue on Saturday. Okay,
Oh, all right.
let's
Okay.
continue on Saturday so that I will not
Sir,
rush.
if it will not be, if we, if it will not stay long, we can continue. If the time, like, you spend 4 or 5 minutes on this, we can still continue, sir.
Okay. So let's give it a try.
It's more than 5 minutes.
Okay, let's give it a trial. So let's see this
Okay.
question. So this question says that on 4th January 2001, an entity grants 100 share options to each of its 400 employees. Each option is conditional upon the employee working for the entity until 31st December 2003. The fair value of each option is 20 naira. You see the way this is how it will be structured in the exam. On 4th January 2001, an entity grants 100 share options to 400 employees. So what do you call this 1st January 2001?
Grant date.
Correct, grant date.
Grant date, sir.
And I said
Date.
each grant is conditional upon the employee working until 31st December 2003. What do we call this 31st December 2003?
Exercise date.
Thank you very much. Exercise date. And they told us that the fair value of each option is how much? It's 20 naira.
20. Yeah.
Automatically, this is the fair value of the option at the grant date. Now, there's this, what's the vesting period? What's the number of years involved here now?
3 years.
2 years.
Thank you very much. So the examiner now told us that in year one, 20 employees leave, and the entity estimates that 20% of the employees will leave over the 3 years. In year two, a further 25 leaves, and the entity now estimates that 25% of its employee will leave over the 3 years. In year three, additional 10 now left. Okay, now look at it. In year one, we are given the first thing you need to narrow your mind down is that okay, what was the value of, in fact, what was the monetary value? In fact, put it as what's the estimate? Put it as what's the estimate of the monetary value I will give to my employees that does not leave at the vesting date? Because that's what I'm concerned about at the end of each year. That's what I'm concerned about. My monetary, the value I have to give to them, to those that are there, because that's the actual thing that should be in my books, not these 400 employees, because it's not all of them that would be there. So, except if the question tells me that okay, in year one nobody is leaving, and we estimate that nobody will leave. Based on the information I have today, nobody is leaving. But now, these 100 share options, right? How many employees would enjoy these options at maturity or at exercise dates? Knowing that the
300
examiner, again, go ahead, please.
345.
345. How did you do that?
I removed audio. I deducted audio employee that left. The 20, 25, and 10.
Láyé. This is year one.
What I'll do is to remove 400, they remove 10 employees from 400.
From 400, yes.
Then we'll have
Say it again.
390. I mean, we had an estimate at 20x3. I'd have
Three,
used the estimate.
How can you be
320.
how can you be using the estimate of year three in year one? Is it because you are seeing this in a question? You have to treat this as if it's real life. This is year one. You don't know what will happen in year two and year three. Oh. You know-
20% of the employee in year one.
Okay, we
Okay.
use 320.
80 employees in year one, 20% of 400 employees.
Yes, 20% of 400 is 80. Now get.
So are you saying that only 80 employees will enjoy this?
No,
320.
For me,
320.
I will use the 10 employees that leave. I will deduct it from the 400 employees total to have 390. I'll now base
Emmanuel,
my three.
They say you should forget about the thing.
how
Okay,
can you be using year three in year one? You don't even know what will happen in year three in year one. Forget year three in year one.
Okay.
You don't even know what will happen in year three. I mean, let's be realistic. This is year one. Of course, I know
Hmm.
that 20 people left in year one. So the company now told me that on the basis of these 20 people that left in year one, 20% of our employee will leave over the 3 years.
Hmm.
So that means out of our 400 employees, yes, 20 people have left this year. That means that they are now saying 20% of our workforce will leave over these 3 years. That means 80 employees will leave over the 3 years, which means that only 320 employees will enjoy 400 minus 80.
Hmm.
That means only 320 employees would enjoy this option.
Hmm.
Because that's the idea, that's the whole idea. Okay. Forget about year two and year three in year one. Focus on whatever it is the examiner has given me for year one. So in year one, they
Okay.
told me that 20 people actually left in year one. And they now
Thank
estimate that
God. Kofi.
20% of the employee will live over the 3 years. That is what you have to always work with, that estimate. Because the whole idea of this, the way I've explained it to you, is that in each year, I want to know what's the estimate of the monetary value I will give to those that would remain. So in year one, at first, I want to ask myself, how much am I giving to people that will remain? When I say that will remain, meaning at the end of year three, there is no way I can know that in year one now. It's only an estimate I can make. And the examiner has made it so easy for you. He has given you that estimate that 20% of our employees will leave. Thank you. So that means they are telling me that 80 of my employees will leave over the 3 years. That means they are telling me that I should make provision for only 320 employees. Those are the only people realistically we believe would enjoy this. We believe would enjoy this. Just 320 of them. So, and they will be able to, we are valuing those options at 20 naira. So how much would this give us?
640, sir.
6.
640,000.
340,000.
So how much do you recognize in year one?
213,000. 333.
230,000.
How did you get that?
Divide by
Divide
3 years.
Thank you very much. Divided by 3, 213,000. And don't forget, this 213,000, you will debit expense or staff cost and you credit what? Equity reserve.
reserve.
Credit equity reserve. So, how should I put it? So, staff costs, so 13,000 Equity reserve, 13,000. Now, in year two, let me see the people that will get this right. Let's see. They said a further 25 employees leave in year two, and the entity now estimates that 25% of its employee will leave during the 3-year period. So that means in year two, I have 100 share options. So based on the information I have in year two, how many of my employees will be available in year three to enjoy this?
It's still
240, sir.
320.
240. 240 employees, sir.
240 employees. How did you get that?
Yeah.
25.
Okay, 320 by 25%, sir. So it gives me 80. So 320, then I remove the 80. So is what I did, sir.
That's logical. But there's just a little thing that you actually missed there because you were working with 320. You were working with estimates 320 when you're supposed to be working with the actual number
400.
of employees, the 400.
Oh, okay. So sorry. Okay. Thank
Yes.
you, sir.
Yes. So they have told us that the entity estimates that 25% of its employees will leave over the. It's like this is a new information that they have now. That over the 3 years, so 25% of all our 400 employees will leave. So this is just like saying 400 minus
100.
100 employees. Remaining how many? 300.
300.
Multiply by what?
By 20.
20.
Ready. So how much is that?
600,000.
600,000. So how much are we recognizing in year two?
300,000.
How did you get that?
Divided by 2 years. 2 and 3.
No.
Okay.
The easiest way for you.
200,000, sir. Sorry,
Yes.
200,000 because it has to be the base, this thing, as you said, the
You
the
divide it
main
by what?
cost divided by
3
3.
years.
Sorry. Uh,
You
3
cannot
years,
divide
sir.
it by 3. If you divide it by 3, that means you are assuming that it should have been 200,000 that should be in year one, whereas it's 213 that is in year one. Thank you very much. It's 2 over 3. Okay, but this 2 over 3 now is not what we recognize in year two. It's the cumulative of year one and year two, which is how much is that? Which is 400,000. So that means that what will go to your staff costs is if the cumulative of year two and year one and year two is 400,000. So just take 400,000 minus what you have recognized in year one, the equity reserve of year one, which is 213,000. So how much relates to year two alone? What's the difference?
187.
87.
187,000. So the same thing, your equity reserve too will increase by the same amount. So if I may ask you, at the end of year two, how much was the balance in your equity reserve? What's the balance in your equity reserve?
400.
Sorry?
400, sir.
100?
400, sir.
Yes. That's correct. 400. This 400. That's the cumulative in year two and year three. Okay. But what you expense in year two alone, because this 400 is year one and year two. Sorry, I mean year one and year two. So just take away what you have recognized in year one before to know what the balance will be. To know what the balance will be. For year three now, for year three, they now told us that a further 10 employees leave. Year 3 is always straightforward because now we now know the actual people that left over the 3 years. So it's like saying 100 options will be given to 400 employees, but we now know that 20 actually left in year 1, then 25 left in year 2, then 10 left in year 3. Then you can then multiply this by 20. So how much will it give you?
690,000.
690,000. So what goes to your staff cost is just 690,000 minus this 400, the cumulative of year 1 and year 2 that you have here, so that we'll know what will go to P&L for year 3 alone, which is 290. Then you credit equity.